Gsfc carries excellent price earning multiple, but questions persist on the quality of earnings as abnormal and excessive subsidy overwhelmingly impacts profits. Two business segments, fertilizer products and industrial products. Fertilizers, predominantly ammonium phosphate sulfate and ammonium sulfate, besides MOP, NPK and diammonium sulfate. And in industrial products, company has remained a pioneer both in caprolactam and melamine. Caprolactam is used in the manufacture of nylon yarn, tire cord, etc. And melamine is used in the manufacture of plastic dishware, in utensils, countertops, etc. And Gsfc has remained a leading producer as a pioneer for over 6 decades, that too with impressive performance. Gsfc has got a strong investment portfolio comprising investment in associate companies from out of its aggregate market capitalization of about 5,000 crores. If we apply a discount of 30% to the current valuation of associates, GNFC contributes 25% of the aggregate market capitalization, GIPC contributes 3%, Gujarat Alkalis takes away 2%, and Gujarat Gas contributes a hefty 30%. And including other investments, the total contribution from associates comes to almost 60%, leaving 40% of aggregate market cap for usage in the core operations. Using this amount, Gsfc is successful in generating a profit of 1,126 crores, which yields a PE multiple of a deep discount 1.77 times in respect of its core business. Added to this is the advantage of potential growth in market capitalization of associates going forward. With its strong balance sheet, Gsfc has an equity aggregating to around 11,800 crores, which supports an asset base of around 14,500 crores. In effect, internally funding assets to the extent of over 80%. With its total long-term capital of 12,670 crores, the company generates an earnings before interest and tax of 1,726 crores, which yields a return on capital employed of around 13.6%, which is not quite good enough in an year of excellent profits. Now, the reason behind this poor ROCE is not considering the return expected from major amount invested in associates. Company's strong cash flow has some inherent contradictions. Strong operating cash flow, more particularly during the last 18 months, but abnormal increase in working capital eating up major part of generations during FY22 and the subsequent 6 months. Company's dividends with a payout of 20% is giving a nominal yield of 2%. The resulting operational surplus eaten up by abnormal increase in working capital. Fixed assets program, more particularly during the last 30 months, has been below 100 crore level and is a matter of concern. The cash flow reflects strong generations but very weak payout. While the working capital increase is a matter of concern, it is in the normal course of business. More particularly, subsidy receivable is a product of date mismatches between the date of booking and the date of accrual at the point of sale and is normal. Gsfc has an advantage in terms of price earning multiple being below that of peers. Its market capitalization appears at the bottom of the ladder at 4,992 crores. In terms of profit after tax, it is quite at an advantageous position. The resulting PE multiple places it at a level of 4.3, which is incidentally below the weighted average PE of 12.1. That apart, it is always prudent to check on the quality of earnings used in the calculation of PE multiple. A look at the segmental profits indicates fertilizers have been dominating the profits. Fertilizer profits have zoomed over last 4 quarters, taking the September 21 EBIT of 93.7 crores to almost 5 times to 430 crores plus, taking EBIT percentage from 5.6% to 23.1% of revenue. Very positive increase and quite substantial at that, but there has been a compensatory angle from Industrial Products Division where there has been a collapse. The EBIT has collapsed from around 200 crores level to a negative of 80 crores with a corresponding fall in EBIT percentage from 22.6% to negative 12.7%. The company has been able to withstand input inflation and the resulting cost pressures, and the company has also weathered the substantial jump in power and fuel cost and increase in import costs from the Ukraine conflict in particular. When we look at the quality of earnings, subsidy is found to drive fertilizer profits to a large extent. Concern is on the fall in the volume of sales, with the fall being more acute during the last 18 months, and the fall in quantity during the period has been more than 15%. There has been an improvement in the MRP realization per ton during the last 6 months. The incremental MRP has been an attractive 7,700 per ton, and during the same period subsidy has overtaken with an incremental contribution per ton of rupees 11,300, aggregating the overall incremental benefits to almost 19,000. But surprisingly, profit has not gone up to that extent. After absorbing the input inflation, the profit has gone up incrementally to the extent of only 8,700, suggesting a major part of subsidy is lost in absorbing cost increases, although we find EBIT increase is to the extent of an incremental 11%. With the aggregate of subsidy and MRP falling down from 19,000 to a level of 8,700, company has got to be worried about the muted volume growth which is hurting its bottom line. Company's industrial segment had to suffer, more particularly melamine, because of the dumping done by China after the anti-dumping duty is removed, and that has forced the company to seek better realization by exporting to newer geographies in Europe, which is a long way to go. The daily chart of Gsfc throws up multiple points. Its 52-week high of 199 and 52-week low of 114 places the current price of 125 at a discount of 37% to 199 and a Fibonacci retracement level of 12.7%. Positive about the share price movement is its upward trajectory in an ascending channel for over an year, and besides that, the negative is the current Fibonacci retracement level of 12.7 is far below the positive level of 23.6% for any firm movement of price upwards. And from the price action perspective, over last 2 weeks, price, quantity and order size all have been falling together, suggesting the trend might not persist for long and there might be a change for better sooner than expected. Gsfc has a mixed bag with positive leadership in production, strong cash generation from operations, attractive PE multiple and massive increase in subsidy, appreciation in the value of investment in associates going forward, but has got concerns with which it is bogged down. Input inflation eating into additional revenue, melamine dumping affecting performance of chemicals division, and falling volumes of sales in both fertilizers and industrial products, a major concern for the company. Hope you found this video on Gsfc interesting and useful. I am Vittal Prabhu with the weekly video on Stock Learning Simplified. You can access similar videos with rich content at our info card on Stock Learning Simplified. We look forward to your likes, shares and comments. If you are new to the channel, may please subscribe and press the bell icon for timely intimation on our forthcoming videos. Thank you so much for your valuable time and kind support. This video is for purposes of information, education and awareness only. This is not meant to be a solicitation or recommendation to buy, sell or hold securities. Wherever applicable, please seek the advice of a competent professional before taking action of any kind.